Hey everyone, Cathie Investor back to another video for today, and this is the first time we're having a look at TOST on this channel. Now, TOST is a very interesting company because it is still growing pretty fast, although growth has been decelerating a little bit, which is also why the stock got hit after they reported their quarterly numbers. Now, throughout this video, I'll do a little introduction of the company, have a look at the numbers that they reported, share my thoughts, and have a look at two analyst notes. Then at the end, we're going to have a look at the graph, but currently this is basically what you're looking at. TOST is trading at $14.24, meaning market cap $7.78 billion with currently a forward PE of 82.3 times, so definitely not on the cheap side. Year to date, it's down close to 21%. But as you can see, with PE, EV to EBITDA, price to sales, the multiple continues to go down pretty aggressively every time they actually report earnings or pretty close to it. Then if we look at the financial trends here, so total revenue, free cash flow, return on equity, gross profit margin, return on capital, it is a positive trend, especially if you look at free cash flow in the last 2 quarters. Positive, return on equity, still negative here, 21.3%. Gross profit margin in the last 12 months has continued to improve, and so has return on capital, although still negative 17%. Then, of course, a quick checkup. Yes, this is a company where Ark Invest, Cathie Wood, has been buying quite a lot in recent weeks. As you can see here, back in late August, they had just over 1 million shares, and now they're at 1.5 million. So they basically increased their position by close to 50%. Now, TOST will also have a new CEO starting January 1st, 2024, called Aman Narang. This happens as the current CEO shifts its focus to its board role. Aman has been an incredible partner, and I'm confident he will lead TOST into its next era of growth and continue to raise the bar on innovation to support the restaurant industry. Now, before we continue, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. Of course, do share your thoughts on TOST if you own it, if you don't own it, if it's on your watch list. Let me know down in the comments below. If you want to support me even further, do check out the links down in the description and the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And then as for the outlook, we're going to have a look at the third quarter numbers in just a bit. The presentation makes it a bit better visually. So with outlook quarter over quarter, it will be a bit flat-ish, if not maybe down. If you look at the low end, adjusted EBITDA, the same thing there, but at least it is still positive. And now, although these numbers still represent growth of around 30-32% year over year, you will see that growth is decelerating each and every quarter. This quarter revenue growth was 37%. So next quarter expected to be closer to 30-32%. And that's why the stock got hit yet again. So first slide I want to show you is this. The restaurant industry is one of the largest industry in the US and globally. So with 860,000 locations in the United States, 22 million locations globally, over $900 billion in annual US sales, that's around 4% of GDP, and over 12 million employees in the United States. Now, of course, I'm not one to tell you how risky the restaurant business is. Maybe some of you are restaurant owners or past restaurant owners, especially in the last couple of years with the pandemic, with shutdowns. We have seen how fragile that industry actually is. I mean, how many times did you want to go eat to your favorite restaurant that you went, I don't know, a year ago, a couple of months ago, and suddenly you find out that that restaurant has closed down? So they are operating in a huge industry, but a pretty risky one, meaning when you get one client, let's say one restaurant, okay, that's great. But maybe in a couple of months from now, a year from now, 2 years from now, you might lose that customer. And so new sales cycle has to start. So it's a constant investment in sales, in getting new customers, hoping that they will not close down their shop. Now, talking about the total addressable market, this is their picture that they're giving us here. So currently they're at $1.2 billion in annual run rate and growing at 40% right now, so pretty impressive. The serviceable addressable market sits at $15 billion. The US total addressable market, $55 billion. And then the global one sits at over $110 billion, meaning they're just at 1% currently. But of course, as we've seen with many other companies out there, just because you show us a huge total addressable market, just because you show us a huge serviceable addressable market, doesn't mean that you will end up being successful into taking a lot of market share. But at least there is a lot of room to grow. So even if you're not very, very successful, you can be a bit successful and still grow quite a lot since the bar right now is pretty low. Then in short, this is basically what you're buying here. So you have a recurring model and a one-time thing. So one time is hardware, professional services, the recurring one, subscription services, financial technology solutions, which if we look at this slide right here, total revenue increased 37% year over year. And as you can see, growth has been slowing down. When you look at subscription revenue, which is the orange one here, that increased 46%, but also growth has decelerated quarter after quarter. Fintech gross profit increased 36% year over year, but the same story here, growth is decelerating. But overall, we're talking here about a real actual growth stock, a real actual growth company. I mean, there are lots of growth stocks out there that are currently only growing 10%, 12%, 8% maybe. But this one is still growing 37% total revenue, and then a couple of segments here, 46% and 36%, and still annualized recurring run rate at $1.2 billion. That's pretty remarkable, especially if you look at this here, 40% growth. And now how do you become bigger? How do you go faster while also becoming a bit more profitable? Well, you just have to look at this. We've seen this with Square, with other companies as well. The more products you use, the better it will be for TOST. So here, a percentage of locations using 6 or more elective products. We're now at 43%, of course, quarter over quarter. That is flat, but if you look year over year, that's up 4 percentage points. And total GPV has increased 34% year over year, but also decelerating growth. But overall, what you're getting here is a growth company that is becoming more profitable, that is still growing pretty fast with improving margins as well. So if everything is so great, why is the stock not moving? Why is it actually dropping? Well, again, it's all in the outlook. It's all in the industry outlook as well. For example, in the earnings call, they said here, so the GPV pre-location, which I commented in the script, is really something we saw late in September and continuing in October, meaning they still see it being down, which of course does not really please analysts and the market. And so we had here Piper Sandler, which has downgraded TOST to neutral from overweight after the restaurant technology platform Q3 earnings call left investors with increased uncertainty on the growth outlook based on descriptions of modest slowdowns in same-store transaction volume and moderating consumer spend. Stepping back, we believe it is prudent to lower our revenue assumptions for next year on any further deterioration over the coming quarters, with risk-reward turning less attractive here. On the flip side, you had an analyst at Bird Equity Research upgrading the restaurant software company stock to outperform from neutral after dropping almost 50% from mid-year highs. While the stock was a bit burnt to a crisp on Q3 earnings, we appreciate the strong growth profile. The analyst noted incremental EBITDA margin was the best we've seen in Q3. If sustained, he added, adjusted EPS could reach about $1 by 2027, assuming around 22% revenue growth. And so this leads me to the last thing here, which is the graph. Of course, that huge red candle here is because of the earnings report. And now last week we had a green one, so maybe investors are comfortable buying in that range here around $14, which was also a bottom back in June 2022. We were there for a couple of weeks and then we made our way back up. Currently RSI is low, but not oversold on the weekly. Of course, on the daily, there is a huge gap right here because of the earnings report. Currently, the 20-day moving average sits at $15.50. And even on the daily, we are not oversold. We're close to being oversold the day after and 3 days after the earnings report. So overall, what you're buying here is a company that is actually still a growth stock, still a company that is managing to grow 30%, 32%, and also becoming profitable along the way, or more profitable along the way. But me personally, I don't really see the point for me, because I own other companies that are also operating in that industry. For example, Square. Square also operates and offers its services, whether it's hardware or software for restaurants. So if I have to take an example, let's look at Zoom, right? You're buying Zoom. Of course, Zoom offers a lot more than just that Zoom call, but let's just focus on if Zoom just offered the Zoom calls and that's about it. Then you can buy Zoom, or you can buy something like Google, which has Google Meets, or you can buy something like Microsoft, which has Microsoft Team in that big package bundle, which is what I'm buying when I'm buying Block, for example, or Square. Same company, but Square is the business that focuses on retail, restaurants, and stuff like that. So although here you're getting a lot of growth and maybe the stock has been hit too hard, in my opinion, I see no reason why I should pass on Block, especially not at these prices, to go with TOST. That's just my opinion, of course. I might be wrong. You might have a counter argument. I'd love to hear that in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.